Imagine if there was a secret formula for building wealth and financial freedom that most people never discover. What if I told you this formula is not about get rich quick schemes or risky investments, but about rewiring your mindset around money in ways that go against everything society teaches? In this video, I am going to reveal 7 insights from the famous book The Psychology of Money by Morgan Housel. This book has the power to completely transform your financial life. These aren't just abstract concepts. Applying these principles will create strong financial foundation, achieve financial independence. But I have to warn you, some of these ideas may challenge your core beliefs about money and success. Are you ready to discover what the 1% know about the wealth that the other 99% don't? Let's dive in. Hey there, I am Palani, a technologist turned investor and an early retiree. I share my experiences from 20 plus years of investing in US and India. On a lighter note, though I stumbled on Morgan's book 3 to 4 years back, I am glad that my wife and I seem to have lived through these principles unknowingly for years. So I can vouch that these principles work. I am sure many people watching this video also are doing the same. Without further ado, let us jump right in. First, live below your means even when income rises. Epictetus, Greek philosopher, famously said, "Wealth consists not in having great possessions, but in having few wants." If you stick to this one smart money principle, which is live below your means, you will be way ahead in the financial journey. This simple rule is the foundation for creating strong long-term wealth. Here, I wanted to share a formula, simple formula for living below means. Here you go. When I say saving, I mean saving and investing. Saving doesn't make one rich. Patient investing does. So, what is the best way to live this principle in these times? Say, for example, you get a big promotion or a rise in salary. Instead of upgrading the lifestyle, invest that additional income. Over 10-year period, that could mean hundreds of thousands in investments. Second, avoid debt for status and wants. Consumer debts for get-rich-quick investments and showcasing status are causes for financial trouble. Question every big purchase. Does this bring value to my life and family? Is this something we can buy without hurting our long-term financial goals? In the early years of your financial journey, buying a luxury car on a 5-year loan just to look successful traps you financially. Instead, driving a reliable, low-cost or used car and investing that extra money builds real wealth over time. Third, focus on your personal goals, not on what others are doing. When it comes to finance, everyone's goals are different. Some might work towards building a business, some might work towards early retirement. So you don't need to compare yourself with others. Just stay focused on your financial or personal goals. Comparison leads to financial decisions that don't serve you. For example, your friends are buying homes, but your priority is, say, starting a business in 2 years. Renting and keeping liquidity might be the better choice. Don't let social pressure dictate your financial moves. Fourth is the margin of safety. Whenever I hear about margin of safety, I immediately think about Warren Buffett. He said, the 3 most important words in investing are margin of safety. He is laser focused on managing risks. When the US market was doing great in the last couple of years, he has been quietly selling those stocks and accumulating 300 billion cash. Now he is happily sitting on that cash looking for right opportunities when market crashes. Similarly, view your life as a portfolio. It is unpredictable. Manage risks effectively. Extra cash helps you weather job loss, emergencies or market crashes. For example, having at least 6 months of salary as an emergency fund gives you peace of mind and flexibility in case of sudden changes. This margin of safety is important when you invest in stock market too. Don't invest money that you need in another 3 to 5 years for your expenses, because in the short term we cannot predict what the market will do. Fifth, time in the market beats timing the market. Example, instead of chasing hot stocks, you invest regularly in market ETFs like S&P 500 ETF or Nifty 50 ETFs, are fundamentally sound businesses. Over 20 years, this consistent approach will likely outperform most active strategies. Sixth, boring and passive investing usually wins. As Charlie Munger famously said, the big money is not in buying or selling, but in the waiting. Say you contribute about $500 a month to your retirement fund without worrying about market highs and lows. In 30 years, that boring habit could build a significant portfolio. Last but not the least, real financial security is invisible. Your neighbor just bought a new boat. You, on the other hand, quietly have no debt, a growing investment account, and freedom to take a sabbatical next year. Who is truly rich? There you have it. 7 powerful insights from the psychology of money. By the way, which of these gems resonated well with you the most? Share your thoughts in the comments below, and if you found this video helpful, give it a thumbs up and share it with a friend who could use some financial wisdom. Until next time, there is to your financial success.